Hi there, welcome to this revision webcast. And tonight we're going to be looking at many different aspects of monetary policy in the UK. Now, monetary policy is one of those kind of macro topics for AS that you can't avoid, you've got to revise it. And you might think with interest rates not having changed since 33, there's not a great deal to say. Truth is there is, and hopefully in the next 15-20 minutes or so, we can cover quite a bit of ground and think about the key aspects of monetary policy in Britain. Keep in mind also that there's a wider context that includes what's happening in Europe, in the United States, and a host of other countries. So we're going to start looking at monetary policy. Monetary policy is often defined as kind of induced changes by a central bank in either the rate of interest, or the money supply, or the exchange rate, or all three. And obviously we tend to focus on interest rates when we talk about monetary policy. And there's a definition of interest rates on the screen for you, either expressed as the reward for saving or the cost of a loan expressed as a percentage annual rate. I think the key point is that monetary policy has been the dominant form of macroeconomic demand management for the last 30 years. Central banks have a pivotal role to play in the economic and the financial system. We tend to talk about interest rates in very general terms. The first part I want to stress to you in this revision session is that there are many, many different interest rates in the economy. The interest rates on your savings accounts with banks, the interest rate on a mortgage, housing loan, the interest rate you pay on your credit card, or if you have to, the interest rate you pay on your payday loan, the interest rate that governments pay when they borrow money, the so-called bond yield. And also when companies go to the credit markets, the capital markets, and issue bonds, they have to pay an interest rate. There are many, many different interest rates. The one that we tend to focus on initially is the so-called policy interest rate, and that in the UK is set by the Independent Bank of England. It's been independent since 1997, and changes in the policy rate help to regulate demand in the economy and feed through to meeting macroeconomic objectives. Actually, that final little section on this slide, macro objectives, reminds me that in most macro topics, it's always good to go back to what are the key objectives of macro policy. And I've kind of summarized them for you on this graphic. Consumer price inflation of 2% is the Bank of England's central target, but that's the only target that's actually a key macro objective that's set in stone. The rate of growth of the economy is important, so too is unemployment and living standards and the trade balance and the distribution of income and wealth, but it's only inflation at the moment in the UK that has a kind of central target. But when you're revising your macro, always go back to the central objectives of macroeconomic policy. Monetary policy, by and large, is allocated to try and keep inflation under control. But keep in mind that changes in interest rates and changes in the exchange rate and changes in the supply of credit, they can also have quite a significant effect on the other objectives of policy. I said there are many, many different interest rates, and here's just a quick example. If, for example, you wanted to take an unsecured loan out from a bank loan of £10,000, for example, you're probably going to pay around 5% interest rate, and that's come down sharply in recent years. If you want a mortgage on a home loan, then it's likely at the moment you're going to pay a much lower rate of interest, somewhere around 2 to 3%. Again, looking at this chart, you can see that interest rates generally have been falling quite sharply in recent years. The base rate of interest is 0.5%, and that hasn't changed since March 2009. Indeed, the election is almost with us. David Cameron's government is the first government to get through 5 years in office without there being a single change in the policy rate. Who knows how far will we get into the next parliament before base rates start moving again? I want to make a quick distinction to help you with revision between the nominal rate of interest, or the so-called money rate of interest, and the real interest rate that you pay on a loan or you receive on your savings. The real interest rate is the nominal rate of interest minus the rate of inflation. So if you're getting a rate of interest of 6% and inflation is 3%, well then in real terms you're getting plus 3% on your money. But oftentimes there could be a situation where the money rate of interest is less than inflation. So say for example inflation is 5%, but the interest rate on a loan, for example, is 4%, and actually the real interest rate becomes negative. And it's just important to be aware that the real interest rate is oftentimes a key factor affecting the decisions that businesses and consumers make. We're in the midst of a situation where deflation is heavily in the news. If we get deflation, the money rate of interest really can't fall much below zero, and therefore there's a risk, a danger that the real interest rate will become positive. So the Bank of England, our central bank, headed up by the Canadian Mark Carney. Bank of England has important jobs to do when setting monetary policy. The path of policy setting is never completely smooth. There are several potholes along the way. The core aim of the Bank of England, and this is something to stress in an exam answer, the fundamental aim of the Bank of England is to maintain price stability, to keep inflation low at or around 2%. You'll be going into the exam knowing, hopefully, that CPI inflation is currently 0. And on most forecasts, it will dip into negative territory in the next few months. Wider to the issue of maintaining stable prices, the bank is hoping that its decisions will help sustain the recovery and help us return some degree of normality in terms of growth and jobs 5, 6, 7 years on from the financial crisis. And again, another kind of side aim of the bank is to try and help the economy achieve a degree of rebalancing. What that means is moving away from heavy dependence on consumption and debt-fueled imports and rising house prices, away from that, and hopefully more rebalanced towards exporting goods and services and providing the conditions where businesses feel sufficiently confident to invest. And the fourth challenge facing the bank, particularly in the wake of the financial crisis, is to try and build greater financial stability. Help, for example, new banks come into the retail market, such as Metro Bank and others. Make our banking system more robust, if you like, more resilient, given that we have a lot of financial and economic uncertainty, not just in the UK, but around the world. This chart, I hope, gives you a flavour of some of the key challenges facing the Bank of England. The bank is required to publish an inflation forecast every 3 months, and this is the so-called fan chart they produce. The darker the red area, the more likely the bank thinks that inflation will be at that certain level. You can see where we are now into 2015, close to deflation. The bank is hoping that it's forecasting that inflation will rise again back towards the 2% mark in the next couple of years. But notice the uncertainty there. This is a kind of key valuation point you can make in essays. Setting interest rates is not a precise science. The Bank of England does not set the inflation rate. The Bank of England can influence the rate of inflation, but there's a lot of uncertainty because of external factors affecting the rate of price change. So what does the bank think about when it's setting interest rates? You could be forgiven for thinking that since rates haven't changed since March 2009, the members of the Monetary Policy Committee have been on an extended holiday with their feet up on some sunny beach somewhere, waiting for the moment to fly back in and make a change in policy rates. Nothing could be further from the truth. My spies at the Bank of England tell me. In fact, the bank is always looking at what is happening in the economy to try and get a good feel for where monetary policy needs to be. They set their policy rate, currently 0.5%, with a view to meeting inflation over the next 2 years. The key point is that monetary policy is forward-looking, because a change in interest rates today won't affect inflation until an ill-defined time into the future. So this chart gives you an idea of the sort of things they look at: how fast the economy is growing, the strength of demand in the credit markets, what's happening to share prices and house values, the state of business and consumer confidence or animal spirits, what's happening in the labour market, to jobs, to wages, to skill shortages, and crucially what's happening to items, indicators such as the exchange rate. The bank looks at a whole range of data to come to a view about whether interest rates need to be a little higher or whether they can stay at the same rate. This chart shows the bank's forecast for GDP growth. Again, the fan chart shows the uncertainty. The darker the green area, the more likely is their central forecast. And notice here the bank isn't forecasting recession. It's very unlikely the UK will fall back into recession in the next 2 years. The central forecast is growth at around 2.5–3%, which in theory should mean inflation should stay relatively low and suggest no real change to base rates. Things they also look at, they look at contributions to inflation. This chart looks horrendously complicated, but actually it's really quite easy. In 2008, the price of oil was surging above $140 a barrel. The price of electricity and gas was rising fast. And if you see there in 2008, those factors alone were adding 2% to inflation, enough to take inflation above 2%. But look what's happening in 2015. Price of oil's collapsed, now trading at around $50–60 a barrel. Electricity and gas bills are falling, albeit a little slowly perhaps. And these factors at the moment are taking inflation down. They've taken around 0.5%, perhaps a little bit more, off the inflation rate. So external factors can have quite a big effect on the inflation. Now the key thing for the bank to look at is the exchange rate. Monetary policy works through the exchange rate. Follow the yellow line here and look at the period 2013 through to where we are now. Last couple of years, the pound has been appreciating against the euro. The pound has been strengthening against the single currency. And one factor there is that it makes it harder to export our goods and services into European markets. At the same time, the pound has been falling against the dollar. If you look at the purple or the maroon line there, the pound has been falling quite sharply against the US dollar. And most of the things we import, oil, copper, rubber, steel, that's priced in dollars. So a falling pound makes it more expensive to import. Exchange rate changes have a significant effect on monetary policy. So where are we now? Interest rates are 0.5%. They haven't changed since March 2009. When will they rise? Crucial decision. Some people think they'll rise in the latter part of 2015. Others think it might be another year or so. This forecast from the Office of Budget Responsibility thinks that rates will start rising perhaps in the autumn. But look at the scale of the change. Even by 2020, the OBR is forecasting that base rates will still be below 3%. We seem to be in an era of very low policy interest rates. How do interest rates affect the economy? This is the so-called transmission mechanism. If you like, it's a technical phrase for saying how do interest rates affect aggregate demand, output, jobs, and inflation. Quickly work your way through the transmission mechanism. When the Bank of England changes the policy rate, they're hoping that's going to feed through to other market interest rates, for example, mortgage rates. When market interest rates change, economic agents will start changing their spending and saving habits. So you'd expect that to feed through to the components of demand. Once interest rates change, eventually you see the effects on output, on jobs and capital investment. And then finally, one would expect changes in interest rates to feed their way through, to work through to inflation and GDP. So this is the so-called transmission mechanism. The key evaluation point is that time lags are crucial to this decision. When the Bank of England changes interest rates, it can take between a year and 2 years for the full final effects on inflation to show through. When interest rates fall, that is called an expansionary monetary policy. And this slide just takes you through some of the effects of how a cut in interest rates would affect aggregate demand. the cost of a loan, the impact on confidence, the cost of servicing a mortgage, and crucially, things like the effect on the housing market, and as I mentioned before, the effect of a cheaper currency on the value of the exchange rate, which then affects exports. Lower interest rates, in theory, should boost demand, should help the economy recover from recession. Just be aware that they don't always work as significantly or as substantially as the forecasters might suggest. Just a few reasons why that has been the case in recent times. A lot of debate in the media about the commercial banks, and they remain unable or reluctant to lend to businesses, particularly small businesses. That's been a constricting factor. Coming out of recession, so animal spirits, business and consumer confidence pretty low. So it's taken time for people to feel confident enough to take on board new loans. A really important point, significant point, particularly for evaluation, is that the interest rate on savings has fallen substantially. And for millions of savers who by and large didn't create the financial crisis, the return on their savings has been falling in real terms and has really hit their living standards. Another aspect is that debt levels in the UK are very high, particularly housing debt and unpaid loans on credit cards. So even if interest rates are low, a lot of people are reluctant to take on any more debt, having had their fingers burnt in a recession. And crucially, although interest rates generally have come down in the UK and are much lower than they were 4 or 5 years ago, actually for some borrowers the rate of interest has gone up. The rate of interest on an overdraft or the rate of interest on a payday loan is many times, 30, 40, 50 times the base rate of interest set by the Bank of England. I want to say just a few words on quantitative easing. Don't worry about spelling it incorrectly in the exam, just write QE, it's much easier. QE came in 2009. The first time the Bank of England's done it, the other central banks got there first. So what QE is an attempt to use unconventional monetary policy to try and affect the economy. Essentially a way of increasing the supply of money in the banking system and hopefully encouraging those banks to lend out and grow the economy that way. But crucially, QE is not going up in a helicopter and just dropping money on London or Manchester or Glasgow. QE is where the Bank of England electronically creates new money, and that money is used to buy financial assets. Let me just quickly take you through how QE works. You don't need to know the full detail, just have an understanding of QE. So the central bank, first of all, creates money electronically. Money is added to their balance sheet. If only I could do that, but I can't. Now that money is then typically used to buy financial assets, the vast majority of which are government bonds, the IOUs issued by the government when asked to borrow money. If the Bank of England's buying bonds, going into the market and being a purchaser, then the price of those bonds goes up. And if the price of the bonds increases, the yield or the interest rate on the bond goes down. Now this is important because the long-term interest rate on bonds is taken as a kind of marker for other long-term interest rates, such as a mortgage for a home or a corporate bond. So essentially QE has caused long-term interest rates to fall, and they're hoping that's going to stimulate lending and borrowing at the long end of the financial markets. Ideally, these lower interest rates and more cash or more liquidity should stimulate the economy. QE could also work through the exchange rate. If money leaves an economy in search of higher rates of interest, the pound would fall and a more competitive exchange rate will boost exports and demand. A brief word about forward guidance. This is topical and quite important. The Bank of England decided in 2013 that they would send a little signal to the markets that they wouldn't change interest rates unless and until unemployment had fallen below 7%, providing inflation was under control. This was an idea by the new governor, Mark Carney, to try and get people to be confident that interest rates suddenly wouldn't just be jacked up before the economy had recovered. This came in the August of 2013, around the time when exam papers are set. And I think the idea of the links between interest rates and unemployment could be a fruitful area for exam questions to discuss. Last year in 2014, Carney changed the forward guidance. He said that they're not just going to look at unemployment when deciding when policy rates will start to rise. This chart shows the projected level of unemployment, or rate of unemployment, published by the Bank of England. See where we are now, unemployment's just below 6%. If you go into the exam, unemployment at 5.7%. The Bank of England's forecasting that unemployment will fall down towards 5%. Will we see a rise in interest rates before that happens? Is that a rate of unemployment sufficiently low for inflationary pressures to start picking up? Or can the Bank of England keep interest rates at 0.5% until the rate of unemployment gets to 5% or even lower? This is going to be an absolutely intriguing question facing the central bank in the next year or so. So overall, as I come to the end of this revision webcast, I just want to give you some evaluation arguments about how well people think the Bank of England's been doing in handling monetary policy in the last few years. Let me start the case by building the arguments for saying that Mark Carney and his team and Monetary Policy Committee have done a pretty good job over the last, let's say, 5 to 8 years. First argument is that partly because of interest rates falling, the economy of the UK has avoided what could have been an extremely damaging depression, a fall of GDP of more than 10%. Without the cuts in interest rates in 2008, 2009, we would have had a depression. I don't think there's any doubt about it at all. Equally, the Bank of England has also managed to avoid deflation. We're close to deflation at the moment. If you look at the experience of other European countries where there has been deflation, the British economy has successfully managed to avoid deflation. Lower interest rates have also helped the pound find a slightly more competitive level, which one could argue has helped our export businesses to recover from the recession. And crucially, just in the last year or two, the Bank of England has kept interest rates at 0.5%. They could perhaps have started to raise them a little earlier. They haven't. I think responding to the crisis in the Eurozone, they've kept interest rates down at 0.5%, and they have kind of marked time, played a wait-and-see approach to their setting of rates. That would be my overview of the case for saying the bank has done a good job in terms of meeting macro objectives. On the other hand, there are plenty of critics of the Bank of England out there, plenty of people prepared to say, no, the central bank is not handling monetary policy particularly effectively. Let me offer you 4 sort of counterpoints. The first is that twice in the last 7 years, inflation in the UK has been allowed to rise to around 5%, more than double the target. So the Bank of England has, on several occasions, effectively lost control of inflation. Another argument is that the bank has kept interest rates too low and that they should be paying much more close attention to what's happening in the housing market, where prices are rising and people are getting squeezed out of the market. There's also an argument for saying that interest rates have been low, but actually little sign that investment has really been stimulated. Businesses have been happy to sit on cash and make higher profits without necessarily funding much needed investment projects. And if you look over to the balance of payments, the evidence is pretty clear that Britain is now running a significant current account deficit in excess of 5% of GDP. Perhaps low interest rates stimulating consumer spending, stimulating the demand for imports, perhaps that's contributed to a bigger balance of payments deficit. So this is a kind of evaluation slide. Some arguments for saying the bank's done a good job and some counter arguments. That's all part of the kind of the evaluation approach you can take in AS Macro. So final points on monetary policy. The first point I want to make is that it's pretty hard to set interest rates in a precise way, particularly when we live in a very unpredictable, volatile world. The UK economy is open open for trade, for investment, and we are exposed to global and regional economic shocks. You know, what's happening in Greece, what is happening in the world oil market, what's happening in the Chinese slowdown. It's pretty hard for a central bank to set interest rates with an easy prediction to make when there are so many external shocks that can affect macroeconomic outcomes, such as growth and inflation. The second key point is that monetary policy is not an isolated policy. You've got to think about how it fits in with the coalition's fiscal policies, for example. So whilst interest rates have been set very low, the coalition has been involved in fiscal austerity, increasing some taxes, but cutting government spending in an attempt to reduce the deficit. And also policy changes in other countries as well. Policy might change in the European Union, for example, or the United States. So the policy set by the Bank of England isn't an isolated decision. You have to think about the wider context. The last point I want to make in this session is that interest rates affect demand for sure, they affect output, they affect confidence, but they also do have an effect on inequality. I just have a feeling this is going to be one of the big stories, one of the significant issues in the months and years ahead. We're starting to see how this period of 6 or 7 years of very low interest rates is affecting different groups and different generations. Millions of people who have saved over the years, their real incomes and their living standards have fallen because the real interest rate on their loan has decreased. And in the housing market, cheap money, cheap mortgages have contributed to rising house prices, which is making housing affordability, particularly for young people, almost impossible. But yet, perhaps interest rates isn't the big story. Perhaps the wider, deeper issue is simply we're not building enough new homes, regardless of the level of interest rates. So this has been a revision webcast on aspects of monetary policy. Please get in touch via Twitter if you want to continue the conversation, or if you have any more revision questions. And thank you for listening.